Alright, let's break down candlesticks, the secret language of trading. You've probably seen those red and green bars on charts, right? Those are candlesticks, and they tell you a story about what happened with price in a set time. Could be 1 minute, an hour, or even a whole day. Each candle packs in 4 key details: the open, the high, the low, and the close. The open is where the price started, the close is where it ended, and the high and low show you just how wild the ride got in between. Now color matters. Green means the price went up, buyers were in charge. That's called bullish. Red, the price dropped, sellers dominated. That's bearish. The fat part of the candle, that's the body, shows the difference between open and close. Those skinny lines on top and bottom, wicks. They mark the highest and lowest price reached during that period. But here's the cool part. You can use candlestick patterns to spot when to get in or out of trades. Looking to buy? Watch for a hammer, a small body with a long lower wick, or a bullish engulfing pattern where a strong green candle swallows the red one before it. Or maybe a morning star, a 3-candle reversal at the end of a downtrend. If the RSI is oversold and you spot these patterns, that's a potential buy signal. On the flip side, thinking of selling? Spot a shooting star, a small body with a long upper wick, or a bearish engulfing pattern where red overtakes green. Evening star at the top of a run, that's your Q2. Pro tip for intraday traders: stick with 5 or 15-minute candles and combine candlestick reading with indicators like RSI, EMA, or MACD. Don't just trust the candles. Always factor in volume, trend, and support or resistance zones. Master candlesticks, and you're one step closer to trading smarter.